put it together. We take cash flows from operating activities. We talked about how to get to this $20,000 balance. Then we talk about the cash flow from investing activities, cash received from the sale of plant assets, and then we're ultimately going to adjust for the cash flow from financing activities to get our increase or decrease in cash, and that reconciles to our beginning and ending cash balance. Get all of these items in the financial statements. Are they part of the cash flow chart? Yeah, it's part of the transactions. And so you're always going to deduct these pieces. The information will be given to you on your exam. In real life, you'll have to understand the transactions and get supporting documents. Like if I was looking at a loan, I'd have to read the loan document. In the notes, these additional pieces, we'd find this out through our investigation, right? So great questions where I would look, and let's say I was doing this for a real company and I saw that accounts long-term payable went up 26,000, or plant assets went up 40,000. I would then have to ask the company, or I'd have to ask the people in charge of those numbers of, okay, why did those numbers go up? And they'd give me some kind of underlying purchase detail. Oh, we purchased this much. We purchased $100,000 in assets. We sold this many assets. It's called a rolled asset roll forward. And then using that, then I would determine how this increase related to cash flows. And that's what this is saying, right? This item in B, item C, is we're saying we'd get that information from the company that, oh, we actually purchased $60,000 of the assets from notes payable, and we actually sold $20,000 in the assets. And that's where we're getting that $20,000 decrease. In this reality, this would be a disclosure on increase in plant assets, non-cash increase. And then we'd say that it came from a notes payable. And then this would be a cash inflow from investing activities. We'd only have a $2,000 inflow, which I believe they're trying to show here, putting it all together. So net cash received would only be $2,000 on the statement of cash flows, because that's all the cash we actually received. And then that loss on the plant assets would be, that we're saying here, loss on plant assets, that's $6,000. It would be a reconciling item to the statement of income, to the reconciling income. So that's where all this comes together. So each one of these pieces goes over in detail this final slide 58. So what I'd recommend when you're studying is go to slide 58 and try to understand where all of these numbers came from. And we've gone through all of them. So net income, $38,000. This is the information we received. I think it goes all the way back to this slide. So it's from 47 down. And then we talk about cash flows from investing. I think we actually use this. I try to use the same example for most of the class. So net income all the way back from operating, we're able to see the final what the final cash flow would look like here. So this income statement, we talked about depreciation expense, adding it back. We talked about the loss on plant assets, the gain on retirement of notes. And then this is the increases or decreases that we walked through. Investments, we just talked about how we got the cash from the plant assets. And then we talk about the financing activity, the $15,000 increase in stock, the cash paid to retire notes, and then the net cash used for financing activities. At the end of the day, we just need to see where cash hit the financial statements. For financing and investing, all we care about is if we received cash or paid cash. And so cash flows from financing, again, right, notes payable. When we we would receive this information, right, that, oh, net notes payable increased $26,000. But then when we review the notes agreements, we might find that, well, we actually retired $34,000 in notes, received a gain on it. This gain would be a reconciling item to the income. And then we paid cash of $18,000, right? And so since we paid cash of $18,000, that's actually cash paid to retire notes of $18,000. Even though our notes payable increased, we actually paid cash on it because a large portion of it was non-cash. Issued 3,000 shares of common stock at par at $5 per share. we received cash for issuing shares, and then we paid dividends, which was our decrease in retained earnings. All of that is showed here. Net cash used in financing activities, we have our dividends, we have our retired notes. So make sure you go back through all of the examples and you understand how each one of these transactions occurred and how it increased or decreased the statement of cash flows. And then since this is accounting, we always have internal checks built in, right? So pulling this up, we know our net income starts with 38,000. All of this together, we had cash provided by operating activities of an increasing of 20,000. We received cash of $2,000 for investing activities, and then we used 17,000 in our financing activities. Oh, sorry, 20,000 plus 2,000 minus the 17,000, which gets us back to our $5,000, which should tie. This should agree to our final balance sheet number, the balance sheet ending balance, and this should be our balance sheet beginning balance. And so we know at the end that these three numbers, the 20,000, the 2,000, and the 17,000, 20,000 plus 2,000 minus 17,000, has to equal our ending balance in our cash, in our balance sheet, our cash. If it doesn't, we did something wrong and we have to go back and check our work. Going through this, right, as a financial analyst, we could go and then see, well, how did the company make its money? Even though they had net income of $38,000, he only received cash of $20,000. The reason that they received so much less cash is because we had a large increase in our accounts receivable and in our inventory. We also had a lot of gain, right? That gain in our notes payable, which really was non-cash. So that decreased our cash inflow by almost half, right? That's significant. And then we could see, well, did we do anything for investing? And I can tell here, we actually aren't really investing. We aren't doing any cash activities to invest in this company. We sold some assets, but it doesn't look like we purchased any, but we need that non-cash section at the bottom to know that we also purchased $60,000 in assets with notes. Then the cash flow from financing. So did we receive, what are we doing from a financing perspective with the company? Well, it looks like we're issuing stocks, so we're taking on new investors. We're retiring notes, so we're reducing our debt. And we're paying dividends to those investors. All of that's useful information just from reading this financial statement, from the statement of cash flows. So we're actually decreasing from financing. So it looks like the company is really focused on paying back its investors and lowering its debt, which resulted in a small increase in cash through the year. That increase in cash generally came through the operating activities. So I'd say looking over this seems like a cheap company, but generally relatively healthy. They're trying to minimize their debt and pay back their investors. That's how we do. And we're going to go into financial analysis more in the next chapter.